Imagine you buy a Coke at the gas station for $3, but at the same time in the supermarket it costs only $1. Same Coke, but different prices. And this is exactly what happened in the cryptocurrency options market if you don't understand the implied volatility. You are either overpaying when buying or not charging enough when selling the options. I'm full-time institutional crypto trader, and in this video I will show you how IV works, why Bitcoin options right now are relatively cheap comparing to Ethereum or Solana options, and how to use implied volatility to predict the price. So hit that like button and let's go! So the Coke is the same in the supermarket and also in the gas station. The only difference is the price that you pay. In options, it's very similar, because the option contract is the same, but the price depends on IV, or implied volatility. And that's why traders who ignore IV constantly lose money. And if you don't want to lose money, so let's take a look what exactly IV is. IV, or implied volatility, this is the market expectation of future price movement, derived from the option prices. And IV is a great factor to compare one option prices to another option prices. And the logic is exactly the same as it is with the Coke prices. So if IV is high, that means that options are expensive, as it is with a Coke at the gas station. If IV is low, that means that options prices are relatively cheap, as it is exactly with Coke in the supermarket. And now let's take a look at the example. We will take a look at the prices for Bitcoin and Ethereum on Deribit exchange. So all options are inverse options, so that means they are trading in the cryptocurrency. And this makes it very easy to compare the option prices to each other. And we will take a look at the call and put option with 28 days until the expiration date. Both calls and puts have a strike price which is 10% away from the current market price. And as you can see, a call option for Bitcoin has a value of 0.0098 Bitcoin for a call option and 0.0094 for a put option. So here you can see the prices for call and puts are relatively the same. And implied volatility for Bitcoin is 35%. And now let's take a look at the Ethereum options. So the call option with a strike price which is 10% above the current market price has a value of 0.0298 Ethereum. And put option with a strike price which is 10% lower than the current market price has a value of 0.0295 Ethereum. And as you can already see, the prices for Ethereum options are more expensive than Bitcoin options. And let's take a look at the implied volatility for Ethereum. And here we go. The implied volatility for Ethereum is also much higher than implied volatility for Bitcoin, and is equal to 61%. So in here is the main conclusion. The higher IV is, the higher the option prices are. And now let's understand why Bitcoin has a lower IV and Ethereum has a higher IV. And for that, we need to take a look at the price chart. And here you can see that the price range of Bitcoin is equal to almost 12% for the last 30 days. And now let's measure the price range for Ethereum for the last 30 days. And here you can see that the price range for Ethereum is equal to 24%, so almost 25%. So Ethereum is much more volatile comparing to a Bitcoin. And this is one of the most important factors which affect the level of IV. And also let's take a look which price range has Solana. So this is a price chart for Solana, and I take also the last 30 days and take a look at the price range for Solana. And here you can see that the price range of Solana is equal to 33%. So that means Solana is even more volatile than Bitcoin or Ethereum. And as a result, IV for Solana should be even higher than Ethereum. And a bit later we will take a look at Solana options and check whether IV is even higher than Ethereum IV. But before that, let's take a look exactly what IV number means and also how to use it. So as I said, implied volatility, this is a market expectation of the future price movement derived from the option prices. So that means this is a forecast what is the volatility will be in the future. And IV represents one standard deviation change in price. But don't worry, this is not that bad as it sounds. And I will explain you this in very simple words. So we just need to remember 1 and 2. So this is simple. So one standard deviation shows that there is 68% probability that the price will stay between this price range. And two standard deviation shows that there is 95% of probability that the price will stay between this price range by the expiration. So one standard deviation is 68% of probability and two standard deviation is 95% of probability. And you will see that is very simple because you don't need to make any calculations. Exchanges have already done them for you. So you just need to find them and understand what this means. And now let's take a look what exactly this 68% and also 95% means. So let's take the same example from the beginning with Bitcoin options. So as you can remember, the implied volatility was equal to 35%. And 35% means that the market anticipates 35% of volatility for Bitcoin. But because we have 28 days until the expiry, this volatility will be less. And let's take a look what exactly does it mean. And here you can see the blue field, which tell me that the price of Bitcoin will stay with 68 probability between minus 10% to plus 10% by the end of the expiration of the option between the next 28 days. And now let's take a look at two standard deviation. And here you can see the expected price move of Bitcoin between almost minus 20% to plus 20%. And as you can see, the probability that the price will stay between this price range for the next 28 days is equal to almost 95%. And the best thing is that you don't need to do any calculations. Everything you need is already calculated by exchanges. And now let's take a look at a real life example on Binance, ByBit and also on Deribit exchange. What does it mean on Binance exchange? So here you can see the option chain for Bitcoin. Time to expire for this option is equal to 28 days. So this is exactly what we have with our example. And to find the implied volatility level, we have to look at the right side on the option chain, which is equal right now to almost 35%. And if we would like to find the expected price move, so in dollar value, so that means between which price ranges Bitcoin price could move between the next 28 days. We have to move our mouse to ATM. And here we can see the price range. And the price range is between $108,600 and almost $132,000. And here you can also find that there is 68% probability that the Bitcoin price will stay between this price range by the expiration. And here we can see the option chain on ByBit with the same time to expiry of 28 days. Unfortunately, on ByBit exchange, the expected price range is not visible, but we can still see the implied volatility, which we can find at the money. And as you can see, it's also very similar to Binance and also equal to almost 35%. And now let's take a look at Deribit exchange. So we have the same 28 days until the expiry date, and IV level we can find in the right corner. Here you can see that the IV level is equal to 34.4%. So also is very similar. And here we can find also the price range, which is equal to minus $11,000 plus $12,000 from the current market price. So the current Bitcoin price for these options are equal to $120,700. And if we would like to find the expected price range, we simply need to deduct 11,000 and add 12,000 to the current Bitcoin price. But also a very useful function that is available on Deribit is expected price move function, which shows me exactly the price range. So I will enable it and you will see it. So here you can see the price of Bitcoin and expected price move for Bitcoin, and expected downside move and expected upside move for Bitcoin between the next 28 days. And this feature makes it very useful to navigate what is the price range of Bitcoin for the next 28 days with a probability of 68%. And if I would like to determine 95% of probability, I need simply to multiply the downside and also upside potential with 2. And in this case, I will have a 95 probability of expected price move of Bitcoin. And it's very important to compare the current implied volatility to historical level, because only in this case I can understand where I am buying the Coke, at the gas station or in the supermarket. And also this is very important for the sellers of the options, because in this case sellers can understand how expensive the options are right now. For that, Bitcoin volatility index could be very helpful. Here you can see the implied volatility level for Bitcoin for the past year. And here you can see right now the implied volatility for Bitcoin is relatively on the low level comparing to the implied volatility between the past 12 months, as Bitcoin maximum implied volatility was equal to almost 70%. So even higher than the Ethereum implied volatility right now. So, and the most important idea from this video is that if the implied volatility is high, the sellers of the options are benefit, because they can sell options at a relatively expensive price. And when IV level is low, buyer of the options benefits, because option prices are relatively cheap. And also I can compare different IV levels of different cryptocurrencies to understand which cryptocurrency offer the highest premiums. But also the higher IV level means the higher volatility. It could indicate a higher risks. So if you would like to trade smarter than 90% of the traders, then subscribe to my channel, hit that like button, and also join my free Discord channel, where you find the market updates, most important news, and you also can chat with me and ask different questions that you have. And I will be really happy to answer them. So it's absolutely free, join my free Discord channel. And also you can watch this or this video, how to trade options. See you in the next video. Bye!